25th September 2023, Monday, MAO with Cal. Now, China cuts bank reserve requirement. Is it a good sign? Well, by right, it's supposed to stimulate economy, and until Friday, the Hong Kong, the China market all went up. But the problem is this. Is this a good sign? No, this is a very bad sign that things is crumbling and things can get really out of hand. And a potential repeat of 1987 is going viral right now. I'll tell you more in detail. Let's go into it. All right. So first of all, disclaimer apply as usual, and thank you, Ames, for the kind sponsorship. Now, let's go into this thing here. Now, China on Friday basically rebounded very strongly, crossed the MA 30 level. Now, that is a good sign, and we thought that that is where the market is going to go higher, right? But apparently, the reason because of this is the real reason. The China cuts bank reserve requirement to basically aid fiscal stimulus, all right? So this is a second reduction in 2023. That means that they did it before, they're doing it again. Now, we saw that was when it happened around here in about this July period. So this is not a good sign because we saw that if they did that, the market did went up for a couple of days. And then what happened? Take a look, guys. The market basically pulls back even stronger, going down all the way, sending all the wrong indication. And of course, right now, the property market in China is terrible. According to my friends in China, they're telling me that now the prices has really went down significantly, between 30% to 50% from the high itself. Now, this is not a good sign because if that continue, the bank will have a lot of strain because all the loans itself cannot be facilitated. So all this itself, and this is going to be bad, all right? And you can see right now that when they do that by lowering the reserve requirement ratio, that basically bring down the weighted average of RRR to about 7.4%. So this is supposed to help, but you can see the market is not reacting positively. As a matter of fact, itself, right, this could send the wrong vibes to a lot of investors. And is this going to happen in China? No. In fact, it's happening now in the same thing in US. Let's take a look. Now, the commercial and industrial loans, can see that right now is coming down to the very negative area for US side. And we've seen it before. When it go negative, wow, this is bad, because then when we go negative, we're going to see recession. We happened again before in 2000. We saw it before in 1991. So all these speaks for itself that the banks are basically tightening and tightening. Now think about this. If the bank tightens, so what will happen to people who basically take loans? They can't get new loans. They can't refinance. And that will be terrible because the banks will push them to pay back. And if they can't, they will default. And then when they default itself, right, the bank will get hit again. So that's the reason why right now you can see that many people is asking the question, we should have the Federal Reserve cutting interest rate. Now let's take a look here, guys. Now, whenever the Fed cut interest rate itself, by right, it should stimulate the economy. So, but the problem is this, when you have risen it for some time, all right, you notice that once you start to tighten out itself, right, you can see that will basically cause the commercial loans to go down. And when that happens itself, the Federal Reserve notice as a problem here, they start to reduce interest rate. But does it help? It doesn't. In fact, when they do that itself, right, that basically tells that the market is having a big issue right now. And you can see right now, the market will go into recession now. So that happened in 1991. So you repeat the same step again, when the Federal Reserve increase interest rate, that is to basically curb inflation, right? And then when that happens as well, right, the commercial side, the loans will get affected, as you can see. And when that happens as well, you notice that recession kicks in. And when the Fed basically cuts interest rate, it doesn't stimulate the economy immediately. As a matter of fact, it basically confirms the recession. So this is what we have been advocating and reminding people that since 1980, whenever the Federal Reserve start to cut interest rate, that means that they know something is terrible, something bad is happening, and that's why they do it. So right now, guys, the Federal Reserve has paused interest rate again. This is not a good sign. And while Wall Street is calling people that they expect that the Federal Reserve to cut interest rate next year, but the thing is this, have they looked at the books? I'm pretty sure they did. But what they tell the retailers, they tell them, say, don't worry, things is fine. You're going to soft lending, but the numbers are not showing at all. So look at this right now. Many people are telling me, Cal, but the real GDP is moving up, right? The one in red. So why are you calling for recession, guys? Take a look here. Whenever the import-export is diving, look at it. When the import-export is diving, okay, you can see that the GDP will follow later and recession is there. So it happen again when the GDP, when the import-export dives, you can see the GDP will come down and recession kicks in. So this is what happened back in 1975, back in year 2000. Of course, we will skip 2000 and also happened in Lehman Brothers time. All right. And of course, it did happen for the COVID period, but we'll skip that because it's COVID. But the thing is this right now, the GDP seemingly is going up, right? But something is wrong. Look at it. The import-export, the goods and services, is actually diving. It's went below the zero marker. So think about this right now. If this is going to be a reflection of what's going to happen next, that means pretty soon the GDP number will dive in. And I feel that the GDP number is actually being massaged at the moment right now. And of course, I can be totally wrong on this, but come on, guys, this is factual. From 1950s to today right now, it's all showing. So if you look at this, this is the commercial and industrial loans in blue versus the net percentage of domestic bank tightening standard for commercial and industrial loans to large and middle banks and middle market and so forth. And you can see that something is wrong somewhere. Well, because you can see right now that when this thing is happening, you can see that when they're moved, they're supposed to move in tandem. But right now, you're seeing that they move in a diverging pattern. You see back in 2000 itself, you can see they move in togetherness. And then after that, when they both came down, that's where recession kicks in. So similarly, itself back in 2008, this thing happened. When they both came down, recession is confirmed. So right now, you can see very clearly the commercial loans are coming down at a rapid pace, which usually will bring down the banking standard, right? But you can see that it's not really following that. So somehow something is about to give in. So once this thing kicks in itself, right, this will really cause a big issue. And that's the reason why I feel that, right, this whole thing will to basically collapse in the months to come. So that's why now you can see business bankruptcy is soaring in August. And of course, when bankruptcy happens, unemployment will increase. We all have seen it before. When the unemployment increases itself, right, that is one start of this recession. So all this restructuring, filing is climbing, and this is not a joking matter. So now that's why there are a lot of people doing this right now. There's a viral image going on. It says that, okay, putting conventional chart on S&P, you notice right now, for this per quarter, every candlestick reflect 3 months. You can see right now the price momentum oscillator used by one of the user in the market says that, right, the S&P has not have a quarterly bearish crossover. Now, what's bearish crossover? Is when you see this, okay? Now, when there's a bearish crossover, apparently the market usually dive by quite a bit of percentage. It happened before in 2001, the same year that I just was talking about. It happened again back in 2008. So the same thing again. So what you saw earlier itself with all the bankings tightening and then the goods and services coming down, all this is the same thing. And that basically, if we put it technically side by side right now, the fundamental is calling for sell. The technical apparently is also calling for sell. So if this really do a crossover, then that means that the market could really come down by a bit of percentage, and this could be in the next 1.5 years. Now, of course, this is not going to be immediate, but if it's going to be happening itself, right, that's why traders, you need to be careful. And that's the reason why I can understand why this Bill Ackman and friends are all shorting the treasuries, because this is going to be a big issue. But the one that basically carries it home is this particular chart right now. So apparently this is going viral. Apparently that there's some similar pattern that happened in 1987, and that's happening right now. So you can see that there's a base in the market, as you can see here, and then there's a top from market. Yes, we saw, and interesting, the market will rebound at the base, which you saw back in 1987 versus now, and then the market will actually do this. Okay, let me show you now. The market will rebound first, which it did, and then you go higher, which it did. But the scary part is that this high will not be any higher than the first high. And now the market will slide down in alarming speed, which is happening right now. So what will happen next? Well, apparently the market is saying that right now the market may do a bounce soon. Now that means the market will purposely test the support level, and then everybody didn't believe that everything is coast is clear. They will buy it up again, and that is where you saw this in based on what happened in 1987. I'm just bringing it to you right now here. And then after that, the second wave, it kicks in again. And this time around, it will be the real one. So if you look at it, this thing here, this could happen in 2 to 3 weeks time, and it will be exactly in line with what I said about this September, October period. Now, again, please don't quote me. I'm just showing you what's happening in the market, what's going viral right now. So of course, if everybody believes that this will happen, it may not happen. Now, for us itself, for TWB student, we are pretty clear because we have this on our site. Take a look. All right, for TWB student itself, our chart is basically giving us early indication right here. Now, ever since here itself, we already know the S&P is going to fall, and we've been very, very open and honest with our sharing, and the market really fell quite a few days, yeah? And of course, did we profit from it? Yes, indeed, we profited from it very handsomely. So the thing is right now, we are at the so-called extremity level. Now, we saw that before, when the market is near extremity, usually the market may do a bit of recovery, right? You can see that. So we suspect that we may see something in the near term. So that actually goes in line with what you saw earlier itself. The market will touch the base first, and then after the following week, a rebound before the real selling. So I don't know what's going to happen, but we tell our traders to go slow because the selling wave is reduced a little bit. So guys, take your profit along the way, but stay safe. And of course, if the market really breaks below 4,300 level, this will definitely shake the market and things will get very dicey. All right, guys, I hope you like this video and I hope you enjoyed this. I'll tell you more tomorrow in next MAO. This is Kel signing off. Like and subscribe and share my video. Bye-bye.